Payments on account are advance payments towards your tax bill. They are triggered by your tax bill being over £1,000 and where you've paid less than 80% of the total tax you owe at source, for example, through a PAYE employment. Now, payments on account often take people by surprise because in the first year they're due, it's going to feel like you're paying double the tax that you were expecting. Now, the best way for me to explain why they exist is to compare between someone who's an employee, for example, and someone who's let's say, self-employed. So employees, you'll be quite familiar that they are taxed usually monthly. So the revenue are really happy with that. As soon as they get paid, the revenue get paid as well. That sounds great. Now, contrast that with someone who is self-employed. Now, by default, most self-employed people will be calculating their profits to the 5th of April each year and paying their tax on the 31st of January that follows. So the revenue are waiting 9.5 months to receive that tax. The revenue do not like that very much. So they will only tolerate that if the tax bill is small, or this £1,000 amount. So the function that they use to put that back into a position where the revenue can be happy again is to say, okay, well, we would like you to pay in advance, and how we want you to do that is pay half of an advance payment in January and half in July. So the way that they do that is to assume that your profits or your tax is going to be the same in the next year as the year that you've just calculated. So they say, okay, well, we're going to have half of that again in January, and we're going to have another half of that in July. Something interesting to consider on payments on account is, are they actually advance payments? So we do talk about them as advance payments, but if we ignore the tax that's due in the previous year, so the year that's gone and we've just calculated it, by the time that you've got to January, when you're going to pay that first advance payment, you're actually 9 months into your year. And by the time that it comes to pay your second payment on account, your second advanced payment, it's July. So you will have finished your year for tax purposes. So there is an argument that they're not really advance payments. They are more advanced than perhaps you were expecting, or perhaps would be normal if you were going to pay everything on the 31st of January. So something really important to consider is that when you then come to the 31st of January and you've paid some of those advance payments, those payments on account, they're going to come off of your tax bill for the year. They're not lost. They just sit there as a credit on your account towards the relevant year. And then you probably will have another set of payments on account. But perhaps when you cease your self-employment or whatever it is that's giving rise to the payments on account stops, you're more likely to have a repayment, because if the income has dropped, then the tax won't be payable, but you've paid some of it. So what about if your income has dropped? So we've just said that the payments on account are calculated by assuming that your tax bill is going to be the same in the current year that we're in as the one that we've just calculated. But you might know already that your income has dropped. So if that is the case, you've got two options. You can either just not pay your payment on account that's due. Now the consequence of just not paying and doing nothing else is that there will be interest charged, or at least accruing, while the revenue don't realise that payment isn't going to be due. You probably will get some snotty letters from the revenue through as well. Some of them can look a little bit scary. But you can do that. You can decide that you're just not going to make payment until you know exactly what your tax position is. The other option is to do something called a reduced payments on account. So formally ask the revenue that you can reduce those payments. That will stop all of the snotty letters. It will stop them accruing interest. However, if you over reduce the payments on account, so that means you set for example, you say, actually, I don't think I'm going to have to pay them, but then you get to the next tax year and you've calculated your tax and whoops, you should have paid a little bit of them, maybe not the whole amount, but a little bit, then it's not going to stop the interest that you've said, I don't want to pay them. The interest will then be accrued by the revenue at the point you submit your return. So with payments on advice, what's my advice as a chartered tax advisor? Well, the best advice that I can give is when you first start as self-employed particularly, or when you first start to let a rental property, or when you're first getting some income that could lead to you having to pay payments on account, then do your best at that point to take regular amounts from that income and save them towards your tax. Generally speaking, 25% of that income would be a really good place to start. In some circumstances that's going to be too much, and in some circumstances that's not going to be enough to cover the tax, but it will give you a really good start, so that by the time that you have to pay those payments on account, you will already have saved the money or a good chunk of it towards it, and it won't catch you by surprise.